Printed out a new seating chart. So I want to follow up a few things from the efficient markets discussion we had. There was some Q&A following class and some hall talk, and so I thought I'd pass on some of the insights from those discussions. First, before we do that, there's a column in the New York Times today on the Bitcoin phenomenon, which for those who are curious about efficient markets and tulip bulbs or Bitcoins, as the case may be, Paul Krugman has a discussion of that. But we're not going to go any further, other than I hope you don't have your tuition money invested in the Bitcoin, a group of the Bitcoins counting for appreciation over the next year. All right, efficient markets. So let's imagine that we think the tech stocks of today, the unicorns, whatever, are in a midst of a bubble. Does the market price give us no information? Or to put it differently, is there no way that an ARB who has done a deep study of the sector can trade so as to provide information about the valuation of those firms? Because after all, how does an informed trader provide information to the market? It's by buying and selling, both in affecting the quantity of stock bought or sold, but also other traders know that, X Jones is the smartest trader on the planet, and will often will often attempt to decode trades by super sophisticated players such as Jones or Smith, and use that as the basis for their trading. So is there no way, even if we assume, and we don't know for sure, that there is a bubble about some of the tech stocks of today, the social media stocks, whatever you want to say, anything with coin in it. And so this is where the idea of relative prices come in. So it still might be the case that even if you're uncertain as to the value of some part of the market, you're still able to relatively value firms. So Apple is just for a given. You might think that the smartphone craze is crested, and who's going to buy a new one when the 11 is roughly the same as the 10 with some new gizmo, a camera that performs a function you don't want? You still might think that Apple is better at what it does than Sony or Samsung at what they do. And so you could provide information to the market about that relative comparison by buying Apple and selling short, say, the Samsung stock or Sony. So what you're saying is I'm agnostic on whether the way the market values this craze for cell phones, smartphones, but I do have a view as to which of those two players, which of the two firms, does a better job given the set of resources and the opportunities in the sector. And so therefore, and this bears on M&A, right? Because part of the claim of the hostile bidder or the hedge fund, the activist challenging management, is not necessarily what the absolute level of the price is or ought to be. It's rather relative to firms in the sector. This firm underperforms on a total return basis, which includes the appreciation of the stock price. So even if you think that our ability to forecast trends is limited, who knows when the bubble, if it is a bubble, will burst, you still might think that an informed trader, that a person who does the research could usefully provide information to the market as to the relative value of two firms in the sector. So that's a way in which some of the trading activity can, even in a bubbleaceous sector, can still usefully provide information to the market, and thus the market price is a better reflection, at least, of the comparative use of resources of those firms, right? Remember, the starting question was, what does the efficient what does the price tell us? A thin version is that the price tells us, today's price tells us nothing more than that's the best predictor of tomorrow's price. We can't do better than, in an efficient markets, predicting tomorrow's price than by looking at today's. Right? All the information is embedded. But that's a pretty thin account of what the efficient market hypothesis has to offer. It might be that we can't go all the way and say that prices are allocatively efficient in the sense that they provide a useful guide to how society's real resources ought to be best used to create value overall. Maybe that's too extreme a claim to make, given the possibility of bubbles, positive and negative, etc. But we might be able to make a more limited but still important allocative efficiency claim, which is, for two firms in the same sector, we can look at comparative prices and price performance and infer something useful about the quality of the management teams in taking real resources and, potential, etc., and creating value out of it. And so, that's a more limited claim than the absolute allocative efficiency claim, but it is still meaningful from the point of view of somebody who cares in a normative way as to whether a given board, a given management team is doing a good job with the resources and the opportunities presented by the economics and the business in the sector. All right? So that's one point. Second point is just because there is a market doesn't mean it's an efficient market. Right? And so this is sort of really important from a lawyer's perspective, from a litigator's perspective. And it has other significance as well. But think about the typical securities fraud case, sort of a litigation for a failure to disclose or a false disclosure. Now, I mean, how many of you looked at the 10b-5 question in the basic course or the SecReg course at this point? Everybody or not many? Well, think about common law fraud. An element of common law fraud is that there has to be a mistake. There needs to be, among other things, a false statement or omission on which a party relied in buying or selling or taking an action. All right, so in a robust secondary market where there's a lot of information coming into the market, let's imagine that the firm puts out a quarterly report that has misleading information about earnings. There's later corrective disclosure and the stock price falls by 25%. So how are you gonna make out a claim for damages in that case? On the account of securities fraud. What are you going to say that there's a misstatement or omission? But what about reliance? Will your client actually have seen the misleading 10, 10, 10, 10Q quarterly report and actually focused on the misstated earnings? No, your client basically looked at the market price and said, I'm prepared to buy at that price. Well, what about reliance? Doesn't the fraud case get blown up because your client never looked at the disclosure? Your client looked at the market price and said, at that price, I'm a buyer. Well, the answer that the Supreme Court has given in Basic versus Levinson, for those who, I hope that rings a familiar bell, maybe it will at some point, is in an efficient market, reliance can be presumed. Reliance on the false, misleading quarterly report can be presumed because the information associated with that false statement will be impounded in the market price quickly. And so, in effect, relying on the price, the buyer was implicitly relying on the information that, in the quarterly report, that produced the price. And this is the so-called fraud on the market theory. Now, every securities litigation faces the question as to whether the market in which the security as to which fraud is alleged trades in an efficient market. Why? Because if the market is not efficient, then what? You can't make that presumption of reliance on the false and misleading statement. So what you'll see in a lot of securities litigation, I mean, obviously where you're dealing with a big stock, the Enron case, right? There's a robust secondary market, tons of traders, securities analysts, etc. Every scrap of information about the firm is pounded in the price. But often, securities fraud will take place with smaller cap firms who may trade over the counter, where the number of securities analysts is limited, where the daily trading volume is not in the millions of shares. And so defendants in those cases will be asserting, lawyers for the defendants in those cases will be asserting what? What? The market is not efficient. Your client needs to show that he or she relied on the false and misleading quarterly report. Did she get it in the mail? Did she open the mail? Did she draw an underline under the quarterly results, right? How do you show reliance in a case like that? And so then you'll have experts parading forth for the plaintiff and the defendant, coming up with theories as to what makes a market efficient or not, and how do you see the demonstration of it in this particular case. So that's the way in which EMH, affects the daily life of the securities lawyer, the litigator. All right, now, we come to the financial crisis. And the claim I made is that the crisis arose because these financial institutions had on their balance sheets securities, mortgage-backed securities, securities whose value depended on the payout stream of the mortgages that were embedded in them. And when the value of these securities precipitously fell, many financial firms were rendered insolvent as a result. That was kind of a critical phase in the disaster. So the question is, well, wait a minute. How could that have happened? Wasn't the market efficient? How did the market not perceive the emerging risk of mortgage default, so that the whole thing was a cliff when it happened, as opposed to sort of a gradual realization as the information built? And the answer is that, wait a minute, the market in mortgage-backed securities was not an efficient market. And now we begin to think in a really deep way about what makes a market efficient. So, think about the Big Short movie, right? So how do those guys, John Paulson, I remember the name, Paulson, and then the slightly weird guy from Colorado, whose name I'm forgetting, how do they make money? They basically looked at the mortgage-backed securities and traced from public disclosure the mortgages that were embedded in the cash flows that created value for the mortgage. It was all publicly disclosed information. Publicly disclosed, yet they made money off of it, right? So what does that tell us? The market was not semi-strong efficient. That's what it tells us. Because they used publicly available information, this stuff about the mortgages in the mortgage-backed securities that anybody could have had access to, and they were able to make huge profits from the opportunistic trading, selling of those bonds. Okay? And, well, damn it, why wasn't the market efficient? Well, one reason is there was no secondary trading in the market. So think about what makes a stock market efficient. It's not that when investors buy a security from the IPO, it's not like they stash it in the portfolio, never to sell it again. No, there's constant buying and selling of securities of parties who determine, and there's a constant flow of information from the issuer about the value of the firm, and experts are assessing that information relative to their own models about the value. So there's an incredible amount of buying and selling, an incredibly deep secondary market in the securities in question. And therefore, parties know that if they take the trouble to learn facts about this firm relative to its peers, they might be able to make money if they're the first to trade on the basis of it. So as a result, this competitive activity of market intermediaries means that the stock market, the stock exchange, the NASDAQ, is a efficient market in the sense that today's price embeds all of the publicly available information about the firm. The mortgage-backed securities market was not a trading market. People bought these bonds when they were issued, and they put them in the portfolio. And they rarely traded, in part because it was hard to get the information. People were not buying and selling. So we realized rather belatedly that the market price that might have existed for mortgage bonds on the occasional sale between institutional investors or banks did not impound all available information about the firm. about the underlying value. That's what we came to realize, that it was not an efficient market. And whatever you think about bubbles, the fact is, since the market in mortgage bonds was not an efficient market, there was no way for the market price to impound the negative information emerging from the underlying mortgages that might have essentially taken the air out of the bubble. So all the available information was not reflected in that price, and that's part of the reason one could hypothesize that prices got so out of whack with the underlying fundamentals of the real estate market. And it also could lead to a remedy, right? You might think about, well, wait a minute, maybe we need additional ways of forcing disclosure, of making it easy for parties to trade, right? In other words, once you've decided that one of the concerns was that the market was not efficient, and you think, then you begin to think possibly of directions that how do you make the market more efficient on the theory that better informed prices would have a feedback against the potential for a bubble. So, anyway, so those are just some of the ideas that come out of, reflecting on EMH and the way that it affects the relative valuation that one does in M&A, and the activism of the hedge funds and the shareholders, which are, in a sense, on a spectrum. That's one. The second is securities fraud, the litigation issues that always arise. And then the third, to think about when is it safe to rely on a market price as having normative value and when not, right? So part of the reason for the sort of the hands-offness about the mortgage market was, wait a minute, it's a market. Market prices are informative as to the underlying economic realities. So therefore, if we were to intervene or, have a supervisor putting his or her visible hand into the market, we're disrupting, this well-functioning market. But what we realize, actually, is that the price was not, we were taking over a metaphor of the market from the stock market and the value of stock prices as reflecting an underlying reality, and wrongly applying it to a market that was in no way efficient, in no way reflected reality or distorted reality. And so the fact that there was a market price here about which we have some view does not mean that the market price that exists in a different market carries the same normative weight as the price in an efficient market, right? And so just because it's a market doesn't mean that the outputs of the market provide the same information to an observer of the price as another market might. Anyway, so, all right. Questions about this? So, let's turn to event studies. And this too, you'll see, we'll get there, has a lot of meaning for the litigating lawyer as well as the sophisticated M&A lawyer. So let's turn to chapter 7. In the case of Allied Signal. So is James Kim. Okay, so James or Jim? James. Okay. Figure 7.4, which is on my draft, is page 88. There's a stock price jump for Allied Signal on a particular day here, a 12.5% jump. And let me just, before we go on, I want to be clear what this percentage is. This is a daily return. These are daily return percentages. And how do we measure return? It's the price on day 1 minus the price on day 0 over the price on day 0. So, and it's that'll give us a fraction, and we can, if we're truly sophisticated, convert it to a percentage, right? All right, so that's what the daily return percentage is all about. It's just the percent stock price change one day measured against the prior day. Okay, so what's the big deal about this 12.5% stock price jump on this day for Allied Signal?
So it coincided with when Edward Hennessy was replaced by an outsider as CEO of Allied Signal.
Okay, so Hennessy is shown the door, and Bossidy is announced as his replacement. The stock goes up by 12.5%. What is the market possibly telling us?
That the investors and people who are in the market to buy shares view this as substantially enhancing the value going forward of Allied Signal.
Why would that be?
They feel that Hennessy is not an effective CEO. Maybe he doesn't manage the resources he has effectively.
Okay, and why would that affect the stock price?
Because there's more value and future cash flows might be greater.
Right, yeah, this is a claim that the stock price change reflects investor expectations about higher earnings, higher dividends, higher payouts, profits from Allied Signal with the firing of Hennessy and his replacement by Bossidy. Okay. Now, what would you, I mean, if I were to, to show you a stock price change and say that, and give you a reading to that in that way, what would you be initially concerned about?
I think you need to be careful about like the time frame that you're comparing this abnormal return to over the other returns.
I mean, could
Yeah, so like here they chose 10 days before the announcement and 10 days after, and they're taking that as they're trying to see what the normal variance in prices without this announcement looks like, and they're basically saying because the 12.5% is so statistically different than the other average trading day price fluctuations that this market, if it's efficient and they're using the information properly. Like this is it's correlated to, or maybe even caused by, the Edward Hennessy news.
Okay, so one issue that you would be concerned about is to what extent is this stock price change, is it an unusual change given the prior pattern of stock price movements for Allied Signal stock? That is to say, there are many factors that could affect the stock price of Allied Signal. Arrival announces a new product, superior product at a lower price. Arrival's plant catches fire. Connecticut, where Allied Signal, I'm imagining, has its headquarters, announces plans to raise taxes or cut taxes. A customer announces a plan to buy more or to stop buying more. There are many bits of information, some related to Allied Signal specifically, some related to the world, which will be affecting Allied Signal stock price. And that presumably will be occurring in a characteristic way over time. The question is, given the history of these fluctuations in Allied Signal stock price, how likely is it that this particular stock price change, 12.5%, is so unusual that we are fair in thinking that it reflects some information that occurred on that day related to Mr. Hennessy. So at one level, one way to think about this is the difference between signal and noise. There's a lot of noise that's in the world, that's random information that's going to be affecting Allied Signal's stock price, right? The problem, if we want to use stock price changes to infer information about the effect of particular announcements on the wealth of the firm, we have to be able to distinguish signal from noise. So that's one big challenge, and it falls under the heading of statistical significance. Okay, we will discuss that in a minute. All right, James, what's the other thing we are concerned about? In effect, deciding how much of this stock price change that we observe from Allied Signal can fairly be said to stem from this Allied Signal specific event, the firing of Hennessy, the replacement with Bossidy.
So I think there's like variance because of noise around the stock price change in general for every day, but then you have to kind of think about how much, like what's your confidence that the 12.5% is the true measure of the abnormal return, because there's also a possibility that the confidence in the true abnormal return is somewhere between two standard deviations below and above the 12.5%.
Well, that's a statistical significance point, right? I mean, what's a more generalized concern? Yeah.
How does that change reflect the market change overall? Like if the entire market goes up 12%, then this company going up 12% wouldn't be that interesting.
Yeah, I mean, for the market to go up 12% is quite a lot. You know, I mean, if we had a negative stock price change, we might, those drops have happened. But yes, but Kevin's general point is right, totally right, right? So before we can assess, in effect, the abnormal return, notice he used abnormal return, right? And so the abnormal return of a stock, in effect, entails a subtraction out of returns that would be normal, conditional on that stock's response to general market movements. So we're now back at beta, right? If the market goes up or down because of general factors, it will have an impact on an individual stock that depends upon that stock's beta, which is to say that stock's historical volatility vis-a-vis the market as a whole. And we said before that there's some stocks, airlines, who, if there's a general improvement in market conditions reflected by an appreciation in the general market, will have a stock price change that is a multiple of the general market change, just because the nature of their business. If markets are good, the planes are filled to capacity, they make a lot of money. Similarly, if the markets go down, they are hurt worse than an average stock like a grocery store. And so in order to determine, in effect, what is the abnormal return for Allied Signal, conditional on the movement in the market as a whole, we need to compute the stock's historical relation to the market. That is to say, we need to compute its beta. And then we subtract, in effect, the observed return, whatever it is, here it's maybe higher than the 12.5%, from the predicted return conditional on the general stock price change in the market as a whole, and that is the abnormal return. So the whole idea of an abnormal return is an effort to take away, subtract the general market movement, which would produce the normal stock price change on a given day. All right, everybody have that? Everybody have that intuition? So, this I want to show you an equation because it leads to, I mean, it's a variation of the CAPM equation that we discussed, but basically the return on a stock, how does this work? Is that the return on a stock, a particular stock, on a particular day, particular return on stock I, just a given stock I on a particular day, is a linear relationship, or it's, well, let me just put it up. It's the alpha for that stock plus the beta for that stock times the return on the market index for that day plus an error term for that day. Whoops, this is not a J, this is a T, sorry. All right, so the return on a stock on a given day is a function of the stock's relation to the market as a whole, plus, in effect, a idiosyncratic factor pertaining to that stock, plus an error term. This is in effect, the abnormal return. So in effect, the way this is done is that there's a statistic. Folks who do this in effect set up a sort of a little graph that shows the absolute stock price relative to the risk of relative to the movement of the market as a whole, the price for the firm I, the market on a given day, and then there's a characteristic line that's drawn that reflects the relationship between the stock price of this firm and the movement of the market index, and the slope of that line is beta, right? So that's just a simple kind of I mean, for those who think in these terms, where does the beta come from? It can be thought of as just the plotting of to use the term, a regression line that the best fit that fits the points that describe a relationship between returns on the stock and the change in the market for the stock for the change in the market as a whole. But it generates two neat numbers that you'll see referred to in the press, and that's frankly why I put it up on the board, because half the class will now be confused. But I mean, you see both an alpha and a beta, right? So the beta term we already know. That describes the volatility of the stock price vis-a-vis the market as a whole. And the alpha is kind of a characteristic part of the return function for a given stock. Stock pickers, here's the punchline of this. This is the value. Appreciate that that the market's going to do what the market does, and so when they pick a stock, they're going to get the return on that stock conditional on beta, the riskiness of the stock, the change in the stock price relative to the market as a whole. They cannot forecast market risk better than anybody, right? That's not their business. They're not a sort of a macro trends predictor. They're a stock picker. What they're trying to do is to come up with a measure of alpha, which is better than the simple regression line measure of alpha. So you hear stock pickers talking about the alpha that they generate, which is to say the part of the return of their performance that they deliver that doesn't depend upon the changes in the market price as a whole, right? I'm good at delivering alpha means that no matter what the market is doing, I can, do a better job than just a passive a passive owner of the security. And they will, and so you hear asset managers refer to the alpha that they're delivering. It takes meaning when you see this equation, which tries in a little bit of mathematical way to describe what the components are of a stock price, which are, again, the relationship to the market as a whole, and then also this kind of idiosyncratic feature, which make be a bunch of things. But so if I'm generating alpha, it means I'm doing a better job than what you can get from just buying the market as a whole, than being a passive investor. That's the point. Okay. Questions about this before I move on? Okay, so James, so let's go to table 7.6, which I don't know what page 91. Tell me how figure 7.6 differs from figure 7.4 and why we would care about the information provided in figure 7.6.
Yeah, so figure 7.6 has the dashed lines around what would be 2 standard deviations away from the 0% line, meaning that you're 95% confident if there's no significant discrete piece of information that the stock price for any given day should be between those 2 dotted lines.
All right, so we're trying to figure out whether the information, again, to distinguish between signal and noise in this 12.5%, the 12.5% abnormal return that we have observed on a given day. And the way we do that is we look at, in effect, the distribution historically of the error term for Allied signal. So we generate a history of Allied signal returns, percentage returns, relative to what we would have predicted given the stock's beta and the previously defined alpha. And that generates this error term. And we look, in effect, at the distribution of error terms. So have a look on, again, the figure 7.4. So we could plot these error terms, figure out, and so there's a range of error terms from plus 2% to minus 2%, minus 4%, plus 4%, and we could figure out the frequency of the distribution of those error terms, and then ask the question, given the distribution that we can observe of those error terms, how likely is it that an abnormal return, the 12.5%, is outside of the pattern of returns that we see within a confidence interval of 95% or 99%. Think of it differently. We have a distribution of returns, and we are trying to figure out, as we did with the coin flips, what is the variance, and then critically, what is the standard deviation? And so we can, in the same way that we can assess the average expected return. The average expected normal return is 0, right? I mean, we expect, given the way we are constructing this equation, for there to be, it's by construction, the average expected return of the normal of this error term is 0, we end up with a pattern of pluses and minuses around the 0 term. We can compute from just looking at how far the pattern goes, what the standard deviation is of the pattern. And so as a matter of kind of convention, we figure out what the standard deviation is, and then twice the standard deviation for this distribution of error terms, this noise. Anything that lies outside the 2 standard deviation realm, we say is statistically significant. With the t statistic, that's the test statistic, of 0.05. T, or it's also called in a slightly different way, a z statistic. Or alternatively, you'll see a little rho, which looks like a p, and you'll get measures of 0.01, which will be similar effect. All right, so again, look at figure 7.6. So one way the simplest way to read this is to say the preparer of this study, who's Joe Grunfest, Stanford professor who was former commissioner of the SEC. In effect, he looked at the pattern of prior returns for allied signal. And in looking at the pattern of the abnormal returns that we've just described, returns that persisted after you subtracted out the market effects, in effect, what we see is a pattern in which over a long period of days, the typical plus and minus, the typical level of noise is maybe +2 to -3%. So from looking at the distribution of error terms, he is able to compute the 2 standard deviation level, these dotted lines, which means that an observed abnormal return that is above the 2 standard deviation line is outside anything that would have occurred by chance 95% of the time, and we say that therefore it's statistically significant. Right, remember what we're trying to do here, right? So think of the coin flip example. How, assuming we have an honest coin where the expected distribution of heads and tails, if we do it long enough, is 50-50, right? How likely is it that we would, if we had this honest coin, get 10 heads in a row, 15 heads in a row? At a certain point, we will say this is so outside the normal pattern of an unbiased coin that we'll say the coin is corrupt, that there will be a signal of a coin that is not a 50-50 coin, that there's information to be had about the quality of this coin. And so in the same way, we're looking at the stock price return to ask how outside the usual fluctuations with respect to the stock is this observed abnormal return that we are epistemologically, as it were, we're defended in saying there's information to be had in the observed abnormal return. It's not just by chance. There's news. And, we say the news occurred on day one, on a given day. It had a stock price associated with the stock price change. There's a correlation that we observe, and we make the leap. This is so unusual given the prior pattern of returns that, it is a statistically significant measure of the impact of the firing of Hennessy and the hiring of Bossidy for Allied Signal and the shareholders of Allied Signal. Okay? So, the goal here, there's plenty sophisticated math that one could do with this, but that's not my point, right? It's to try to assure that there is, that the intuitions are clear. All right, now, James, notice that this is a one-day event study. In effect, we're looking on the announcement day returns. Do you think we should limit ourselves to just looking at the one-day stock price change? Or what's this was an unusual event. Suppose we're looking at the stock price change associated with the announcement of a merger, which will lead, of course, assuming that we're looking at the stock price change for a target, let's say, or an acquirer, and we're trying to figure out what maybe the acquirer, because the target stock price change is going to be reflective of the premium in the end. But suppose we're trying to figure out if the merger is a good or bad thing for the acquirer, at least measured as of the time that the merger is announced. So the event study methodology, it measures investor expectations as to the effect of a future a future change in the business at the time when the event is announced. So the merger is announced, and we won't really know whether it increases synergies or whatever until it happens, right? It happens when it happens. But investors will have an expectation about what's going to happen, and that's the announcement day effects or the announcement effects. And kind of, intellectually the way this thing works is that we figure investors on average are going to be correct, particularly over time, because they will observe similar phenomenon over time, and eventually they get pretty good at assessing whether particular acquirers' takeover of target will or won't create value for the shareholders of the acquirer. So there's a view that the stock price change, which is a prediction of what the economics will be in the future, nevertheless sheds something of value about the likelihood of that actual fact occurring, right? So that's the deep way that observing the stock price change, which projects the future, can be taken as having meaning in a normative sense as to whether the transaction is good or bad. But in the case of a merger announcement, we're trying to figure out whether the acquirer's shareholders believe that this will be a good or bad thing for the acquirer. Should we limit ourselves to the day on which the merger is announced?
I think that there could be people who have like rumors of the merger announcement, so they could be trading on the information, or the market might just think there's a rumor about a merger, so it's hard to determine what the day zero really is.
Right, and so a big issue in event study is essentially, when does the event hit the market? When does the news about the event hit the market? Because remember, we're trying to collect all of the signal relevant to the particular event. If the question is, does this merger create value for the shareholders of Allied Signal? And if it is predictable that various parties and intermediaries will know about the merger before it's announced, and we can observe that frequently there is a run-up in the stock price or a change in the stock price, up or down, before the announcement, we can infer that there's investment bankers trading, or, who knows who's trading and why. But the point is, if we're really trying to collect all the signal associated with the news, the event, then we may have to expand the window beyond just simply the day on which the merger is announced. So, James, does that create any trouble for the use of the event study methodology?
Yeah, especially if you're trying to litigate whether this event, there's news, had the impact that you're trying to argue, because it's hard to know what the appropriate time frame is. So,
well, suppose we want to say, look, I want to make sure that every last bit of signal about the merger is picked up in my study, so I'll expand the window to 4 days prior to the announcement day. Why shouldn't I just do that?
because it also picks up more of the noise from those 4 days that could just be unrelated to the.
And therefore,
it's less like the statistical significance.
Right. Yeah. The longer the period over which you're collecting signal, the longer the period over which you're collecting noise, and you then run into the risk that you may lose the validity of your statistical measure. So let's just see, take a look. I have a couple intuitive ways to get at this. Take a look at, I'll do the first one first. I'm going to do a little dance here. I don't know if I can be seen. Very, very slow steps, right? So basically, if you figure that on a given day, stock prices will move in a random way, up or down, and I don't know why. The question is, and I have a fixed signal. The intuition is the more days the stock price gets to move in a random way, the less likely it is that the fixed signal will not be within in effect, the randomness over that period of days. So think of it this way, in a kind of a physical manifestation. Assume my signal, I'm here the signal is here, right? And I'm standing here. And if I have only 1 day to move in a random way, and I move the 1 day, well, the eraser, my signal, is outside the bound of the 2 standard deviations of my 1 day of random movement, right? But if we add more days of a random movement, we're at 2, we're at 3, we're at 4, we're at 5. Oops. This is randomly the 2 standard deviations, And all of a sudden, the signal, which hasn't changed much, is now going to be within the 95%, not outside the 95%. It's within the sort of the bubble where the stock price could have moved just by chance, because I've had so many more days to move in a random way that all of a sudden I've lost the ability to claim that the observed signal is so far outside the randomness of the movement that it's statistically significant that I can infer information on the basis of it. So less dependent on my fancy footwork. Imagine again in Figure 7.6 that the news about Allied Signal's firing of Hennessy, replacement with Bossidy, had kind of leaked out over a week. It was announced that the Allied Signal Board was going to, a week previous, news was received or leaked that the Allied Signal Board was going to meet in a special meeting a week from today, right? You know, maybe somebody had to cancel, dinner plans to go to this board meeting, and he or she mentioned sort of a columnist for the financial press, or maybe it was a dinner with that columnist, and the columnist, Allied Signal's been having some trouble. My friend had to cancel dinner, puts it in a Heard on the Street column, and all of a sudden Allied Signal stock price begins to move. And then, phone calls are made, the gossip goes up. The point being, there will be stock price changes all during the prior week. And if you were to accept none of them, let us say, on any given day, because we aren't really sure, well, maybe, this person is also on another board, right? Or, it might be that there's going to be some important merger development, a positive thing. You don't really know why there's the special meeting or whatever, or why dinner was canceled. Maybe I'm putting two plus two together. But the point is, if in effect the news about the Allied Signal personnel change were to leak out over a long period of time, and on no day, in effect, was the stock price change greater than 2.7%, then, in effect, you collect all the signal from the prior days, but it's not statistically significant, because it's all within the kind of the envelope of expected randomness, of expected noise, conditional on the prior pattern of noise for Allied Signal, right? So the point I want to make here, it's an important methodological point. When it comes to event study methodology, on the one hand, often the news about an event will distribute itself over multiple days because of leaks of various types. But our ability to claim that this signal, that the information we're collecting is signal rather than noise, means that the more days over which we're collecting this signal, collecting news reflected in abnormal return, the more challenging it is to be able to say that this is statistically significant. So we want to know all the market reaction to the announcement of this firing and hiring. But as we broaden the days over which we're collecting the market's reaction, we're also increasing the amount of noise that we're collecting as well. And the consequence might be that we lose the capacity to distinguish signal from noise as reflected in our definition of statistical significance. The final point in here, I want to try to be quick because I know we're running out of time. And we'll come back to a little bit of this tomorrow. Often, what we want to know is not what the shareholders of Allied Signal thought of this particular turnover. But we want a deeper view. We're looking, when boards fire a CEO and hire a new one, are they acting in ways that increase the value of the firm? Or are they perhaps panicked because some securities analyst wrote a snotty review of management's performance and the board panicked and just, fired the person, acting precipitously? Well, how would we figure this out? We would, in effect, assemble a portfolio of firms that underwent similar experiences, a CEO turnover. And we would be trying to, for each of those firms, figure out, in effect, what the market reaction was, and whether that market reaction was statistically significant. And then as we looked at the portfolio as a whole, as we averaged the market's response to these separate firings, we would be in a position to say boards generally fired the CEO because of actual poor performance. Because or at least in the eyes of the shareholders believed that the board was acting for the shareholders in firing the CEO because the stock price on average went up, as opposed to the shareholders believed that the board was panicking because the stock price on average went down. And what we will observe, again, is that the bigger the portfolio of firms we collect, the more likely it is that we would be able to show statistical significance for a given result that averages the expected returns across the portfolio. So think of it this way. For every individual firm, there's an expected return, there's the abnormal return and noise. Abnormal return and noise, etc., right? What we could show, again, in the fancier way of construing this, is that, in effect, the noise across the portfolio will cancel itself out. So instead of adding noise by expanding the window, when we put more firms in the portfolio, we reduce noise, because pieces of the noise cancel one another out. So in effect, an average return, it's easier for a given level of abnormal return in the portfolio, it is easier to show statistical significance for the portfolio than it would be for a given level of abnormal return for a single firm. So maybe tomorrow I'll try to expand on this a little bit. The main focus for tomorrow, though, is going to be an event study, the Bradley, Desai, and Kim study, where part of the point here is to just appreciate in a rough way how the data was collected. But what is more important than the technology of the data collection is how to use the data, right? What can you infer from the data? And that's what I really want for you guys, is to sort of to understand how the data collected through methods that, this course is not going to help you, it's not going to expect you to be a master of. But with simple ideas about abnormal return, statistical significance, there's a lot of empirical information highly relevant to M&A that you will now get access to. And the Bradley, Desai, and Kim study is a nice example of that. And so I want folks to look at it in a close way, and I will, that'll be the main focus of tomorrow. Before we begin that tomorrow, if there are methodological questions, or technical questions about this event study methodology, we'll start with that. I'll do a short review of what I've just said, but so try to absorb the methodology from the point of view of sort of how do I now use it in extracting news, as it were, from the Bradley, Desai, and Kim study. Okay, see you tomorrow.
TA sessions in here will start in about 5 to 10 minutes. 10 minutes. I'll give you guys 10 minutes.
Hi.
I don't know where it would come from.
Well, it comes from I'm looking for a little picture I have here. It comes from do you know anything about technical? Do you know anything about regressions, or no?
Oh yeah, we tried to solve with Professor Talley and some point.
Okay, so basically the alpha is just the the x-intercept. So basically, we